안녕하세요. 한국경제신문의 김현석 뉴욕특파원입니다. 시장이 굉장히 혼란스럽습니다. 네드 데이비스 리서치의 에드 클리솔드 미국 주식 수석 전략가를 모셔서 시장에 관련된 여러 가지 궁금증들을 들어봤습니다. 여러분들의 투자에 큰 도움이 됐으면 좋겠습니다. First question. Last year, investors were worried about the hard landings for the US economy, but as disinflation appears, hopes for the soft landing grow. This may be why the stock market rallied in January, but last Friday, employment data came out very strong, and the services PMI also moved back up to the 50. Some claims no landing scenarios now. Which scenarios do you believe in?
Yeah, so I think that the odds of a recession have decreased substantially, at least for the next several months. Uh, there's a risk as we move into the end of this year and into 2024 that a recession could take place. But I think that the market was concerned with the data at the end of 2022 that the economy in the US was about to go into recession in early 2023. But the latest round of data suggests that's not the case. A no landing, that is, the economy doesn't slow down at all, and if anything reaccelerates, I think it's probably a little bit less likely as well. So the at least for the next 6 to 9 months, the soft landing appears to be getting more and more likely.
Oh, okay. That means the stock market will gonna have good days for the in first half in this year.
Yeah, that's how the market usually reacts when inflation is slowing and the economy is not going into a recession. So what we saw last year, that the size of the decline, which was 20 to 25%, depending on if you want to use the Dow Jones Industrial Average or the S&P 500, and lasting about 9 months or so, was about the average for a bear market that does not have an association, does not have a recession associated with it. So the kind of decline we saw is very typical if there's no recession. So now it's a matter of the market recovering and potentially, pricing in, at least for now, that the odds of a recession have diminished.
But do you expect recession will eventually come to the last of this year or next year, right?
Yeah, I think the risks of it increase later on because while inflation is coming down very quickly in the US and probably will continue to over the next several months, just because the year over year comparisons this year versus last year are going to be easier. And then also there's still some benefits of the post-COVID supply chains easing that will allow that to happen. And then also in the US, the way we calculate the impact of housing is somewhat delayed versus what's actually going on in the economy. So the weakness in housing that we've seen for the last several months is just now showing up in the inflation data. So that's going to allow inflation to come down for the first half of 2023. But the second half of 2023, we could see inflation start to reaccelerate, which then brings into play potentially more Fed rate hikes. So the Federal Reserve could pause for a while, but then if inflation's running a little bit higher again, then we could see the Fed tightening again, which could then raise the risk of a recession.
Why do you believe the inflation will gonna reaccelerate? Is that some other reasons?
Yeah, so one of them is just the year-over-year comparisons get tougher in the second half of the year, but also there are some things in the US labor market that are really happening on a one-off basis that are going to be with us for a while. For example, baby boomers or older workers left the labor force during the shutdowns and haven't come back. Most other developed economies have seen their baby boomers come back to the labor market because what we did in the US is we allowed companies to fire workers and then we paid them directly. Whereas most other economies, they paid companies to keep people on the payrolls. So when their economies reopened, they just went back to work. not so much here. So we have millions of older workers who have left the labor market, and now we're having to fill them with younger workers. In 4 years, that may be great because they'll be very productive, but for now, they're not. And that's keeping the labor market very tight. That's why you saw such a great jobs report last week. And you see the unemployment rate, near its lowest level in the last 50 plus years. And so that means inflation could move higher again in the second half of the year because the labor market will be tight, good job growth, and wages may remain pretty high.
And Chairman Powell, we're gonna speak in a minute after our interview, but he actually spoke positively about the inflation and the possibility of soft landing last week. And was Chairman Powell too soon to declare victory in the fight against inflation? And what is your estimate of the final rate? And when do you see the rate cut?
Yeah, I think Powell has done a good job overall of communicating with the markets over the past year. I think potentially his comments were maybe misinterpreted to think that the Fed is really ready to cut rates over the next several months. I think instead they will probably raise rates in March and maybe one more time, and then at that point take a pause because they've done a lot and see the effects of those rate hikes on the economy. But if inflation does in fact start to move higher in the second half of the year, then I think we could get a couple of more hikes then. So the end of the tightening cycle could come quite a ways away from now. It could be almost a year from now. So think of what may happen in the next few months as a pause and not necessarily the end of the tightening cycle.
So how will the stock market play about that kind of a scenario?
Yeah, so I think the rally that we've seen for the first 5-6 weeks of the year can continue for a while because we had priced in so much of a slowdown, and investor sentiment, that is how people felt about the economy and the stock market, has been so negative for so long that everybody who wanted to sell probably had their chance to do it. And that's why we think the rally has been so powerful, is that there are so many people who are sitting on the sidelines and not invested. So for that reason, we think the rally can last for a while longer. But we'll see, what happens in the second half of the year, whether or not the rally takes a breather at that point, and we'll have to see, what the inflation and Fed outlook is at that point.
That means you think still bear markets are playing right now, and so there will be a lower low than the lower of the last October, right?
Well, we'll have to see when we get there. We'll see how big this rally is. So if we've come a long way, and if it continues for several more months, the next decline may or may not take us to the October lows. But I think the big picture is that we don't necessarily want to think just because we started a really good rally, and if it turns into a bull market, then necessarily it's going to last for the next several years. We need to think in terms of the next couple of quarters, next several months. And then we'll see how things are after that to see how big the decline may be. But yeah, I don't think this whole Fed cycle impact on the market is over.
Got it. The labor market remains strong. When will the effect of Fed tightening become apparent in monthly payrolls and weekly jobless claims and unemployment rates, etc.?
Yeah. So as we talked earlier, the challenge is that there are so many people, not in the labor market before, and that's why you're not seeing in the aggregate numbers. Now, what you have seen in certain parts of the labor market, and also the tech sector, you've seen lots of layoffs there. That has been that's where you'll see the weakness. It just hasn't been enough to filter through the entire economy. So I think it could be several more months before you see the labor market slowing enough that the Fed will be satisfied that you're going to see weakness in the labor market lead to slower economic growth. So I think the labor market remains strong for a while.
I think the biggest variables in inflation is oil price. And how do you see the oil price to move?
Yeah, so oil has defied a lot of experts. 9, 10 months ago, most energy strategists thought we'd see oil at $200 a barrel, and it just didn't get there because of weakness in China with their shutdowns, also substitution to with other sources of energy. But from here, I wouldn't be surprised if the U.S. economy, does remain fairly robust. That we would see oil prices rally. From here, we could we could see a 10 or 15% gain in oil over the next several months, in conjunction with expectations for a stronger economy.
Is it gonna impact negatively to the inflation?
So eventually that would filter through, absolutely, especially once you remove some of those disinflationary factors, over the next few months. Again, as we get in the second half of the year, maybe that's when you start feeling the effects of higher energy prices in the overall CPI.
Oh, got it. The earning seasons doesn't seem too bad to have a big negative impact on the market. Do you think the coming recessions will put the share price down, or when will earning recession appear?
So I think the expectations coming into the earnings season were so low that the fact that it wasn't a disaster, the markets took it as a positive.
Right.
So actually, the beat rate, or the percentage of companies in the S&P 500 that have beaten their consensus estimates, is 71% as of right now. That's the lowest beat rate since the shutdowns in 2020. So companies have not done particularly well. I just think that the expectations were so low that the market was able to move past them because of all these other factors with inflation and the Fed. So going forward, we think earnings growth will continue to decelerate over the next several quarters. One of the challenges is that wage growth remaining strong will hit profit margins, because for most companies, wages are the biggest cost. And so we don't look for a great rebound in earnings growth. And then if the economy does fall into recession, then you'd expect a much bigger decline in earnings growth. On average, S&P 500 earnings decline about 25% during recession. So that would be a pretty big drop from here. The challenge with earnings is it's a lagging indicator. That is, the earnings decline after the economy and after the markets. So we might not see those really bad earnings numbers for a while, until the economy would fall into recession.
You mean you said earning is the lagging factor? That means that will not gonna slow down the stock prices, right?
Yes. Exactly.
Coming
Yeah.
forward.
Yeah. I don't think that's necessarily going to be a big factor for the market. It's going to be more about the economy and the Fed, because I think people have already adjusted their expectations to lower earnings growth, and then we'll have to see how the economy does from there to see what the impact of the economy on earnings would be.
Okay. And what are your thoughts on tech stocks, and including Meta and Microsoft and Tesla, etc.? Many tech stocks have recently rebounding big, and is this the time to chase it, or is this time to sell it?
So early in a market recovery, usually the stocks that were beaten down the most, who did the worst during the bear market, are the ones that do the best in the bull market early on. So I think these stocks could continue to rebound for a few more months. But once we get past that, I would expect them to return to being laggards, because if inflation does come back, then that would be more favorable to energy, materials, industrial sectors, and less favorable to the tech sector. And once the last cycle leaders lose their leadership status, they generally don't get it back. You think about what happened in tech after 2000. They went through a 9-year period before they started to outperform on a sustained basis again. Same thing with financials. After the 2008 financial crisis, they took a long time to recover. So once the baton is passed, that is, it goes from one sector to another, we expect that it'll stay that way for a while. So this is a short-term rebound in all probability in the tech stocks.
Got it. And have a treasury yield peaked, do you think? And will the 10-year yield rise above 4% again? What level do you expect by end of this year?
Yeah, I think 4% would be a little high. I think from here, again, with a little bit better economic growth, a little bit higher inflation second half of the year, we think we could see bond yields tick back higher, maybe somewhere around the 375 area on the 10-year treasury yield would be an area we'll look at. But again, as we move toward the end of the year, if we start to price into economic weakness, if the Fed is hiking again, then we would see long-term interest rates like the 10-year treasury will probably come back down again.
Okay. I would like to ask about the QT. And what are the negative, why are the negative effect of QT not showing up in the market yet?
Yeah, so I think it's because the Fed has been tightening so much that QT has been minor in the grand scheme of things. There's been several academic studies showing that what the Fed did with QT last year is equivalent to maybe 3 interest rate hikes or 75 basis points of interest rate hikes. And the Fed was doing that at every meeting for a while. It's there somewhat, but I think that the most dire fears of all the liquidity being taken away through QT, have been shown to have not happened, at least not yet.
Is there any possibility the Fed will gonna increase the monthly amount of QT to tighten the financial conditions?
Yeah, so Powell was interestingly not concerned about financial conditions, which have eased over the past several months.
Right.
Whereas he was looking at the year-to-year change, and most investors were looking at the last few months. So as long as the Fed you continue to look at what's happened over the last year and the last few months, I don't think they'll use QT to do that. But financial conditions continue to ease and markets continue to rally, then they very well may start to use QT as a way to manage expectations and manage the investor optimism.
Okay, thank you. Is there any possibility that the debt ceiling problems will shock the market this coming summer? When do you think the X date is? And is there any default? Will long-term treasury yield rise again just like 2011?
Almost every time, cooler heads have prevailed in the U.S. Congress. They use this as a negotiating tactic, but when it comes to actually defaulting, there's enough people in Congress to realize how catastrophic that would be for the U.S. economy, for U.S. voters who would have to vote for them in just a few months. So they would. I would expect that they will eventually raise the debt ceiling, but there's always the risk, and I think if it does come down to the 11th hour, you could see a market reaction. But at the end of the day, they'll raise the debt ceiling in all probability. So maybe there could be a short-term impact, but bigger picture, I think that the markets know that this is politics and not economic policy.
There is a lot of noise caused by Chinese spy balloons, and will China some see this issue as having a negative impact on the market? Will this issue make the U.S.-China conflict more serious?
I think in the big picture that this is not a major problem. It was, the Biden administration clearly didn't want this information to be made public, but it got out anyway. And apparently, allegedly, this happened during the Trump administration a couple of times, and they did manage to keep it quiet. So that implies that the U.S. government isn't overly concerned about this. There's a lot of different ways that countries can spy on each other without putting a balloon at 70,000 feet in the atmosphere. So this is probably a lot of good things to talk about and speculate about. But the real issue is that the U.S. and China economically are no longer aligned, and balloon or no balloon, that's not changing, and that's going to be challenging for Chinese economic growth. And it's another reason to think that over the next few years, U.S. inflation may be a little bit higher if companies are not sourcing their goods through China, which would lead to lower inflation. So I think that those big picture factors are not changing because of the balloon incident.
Okay. China lifted the lockdown surprisingly quickly. Will China's economy recover rapidly like this? Can the real estate slump be solved?
So yeah, I think the Chinese economy can recover fairly rapidly, just like a lot of other economies did. Once people realized that the lockdowns are in all probability over, and people adjust pretty quickly to life. Most people, there's some that won't, but so I would expect the Chinese economy to rebound. The challenges in the housing sector are very complex in China with a huge debt overhang and overbuilding for many years. But the reopening will probably help the real estate market over the short term. But there are a lot of long-term problems with the Chinese real estate sector that go beyond COVID, and the Chinese economy will have to deal with over the next several years.
Okay. The value of dollar is rising again. How do you expect the dollar to move?
So, the dollar has weakened over the last several months until very recently. I think that has been following the interest rate expectations that the market was trying to price in Fed rate cuts. I think if the market starts to look ahead and come to our way of thinking that perhaps this would be a pause and not the end of the tightening cycle, perhaps the dollar could strengthen a little bit more. Not anything like what we saw, for most of last year. We saw the strongest dollar in almost 4 decades for the first 9 months of 2023. So not like that, but I would think that the dollar could firm as interest rate expectations move.
I want to ask about the gold, and gold is approaching $2,000 per ounce. And is this a good time to invest gold?
So we have been positive on gold, sort of like the opposite of the dollar. So if the dollar were to strengthen, I think gold could pull back somewhat. As it hasn't been the best inflation hedge over the past few years, but over the next few years, if inflation comes back, I think that gold could do fine in that environment. But maybe over the short term, gold has perhaps seen the best of its run.
And many worst funds recommend investing overseas, like Europe or EMs like that, and because of better yield and much better valuation than the United States stock. And do you agree, or is there any risk factors?
Yeah, so I am the U.S. strategist, right? So I admit I have a home country bias, but I do think that there are a lot of opportunities outside the U.S. that there haven't been for the past decade. As you mentioned, economic growth in a lot of other countries has been surprisingly strong. You've seen stock markets in Europe recover much stronger than what many people expected when the Russia-Ukraine conflict started, and so the valuation difference, that is, the U.S. has been so expensive relative to the rest of the world, it didn't matter when the U.S. was growing so much better than everybody else. But if that's not going to be the case, then the valuation differences matter. And then the other thing is that the U.S. stock market is heavily weighted towards mega cap tech
Mhm.
stocks.
Mhm.
And so if they're going to be underperforming over the next couple of years, that's going to weigh on the US versus, say, Europe or some emerging markets which have higher weights in energy, in financials, in utilities. So if those sectors outperform globally, then that would benefit those countries over the United States.
Got it. And what do you think the black swan will be this year?
Yeah, great question. And it's, well, if it's a black swan, then it's not known, right? But I think one thing to keep an eye on is if there is some sort of other supply shock that hadn't been seen, given how tight the labor market is and how supply chains are not quite as efficient as they were in the past. I think the global economy would be even more susceptible to some sort of supply shock, be it with commodities, semiconductor chips, or whatever else in the global supply chain. If you remove it, and it would take a while for the economy to adjust, and I think that could be a shock to the system.
Got it. Thank you very much. Thank you for your insightful answers, and it will be a great help for our viewers to invest. And thank you again for being with us.
Oh, thank you for having me. I appreciate it.